I had the chance to attend a faith-driven entrepreneurial meeting this morning here in Lynchburg, and it was really cool to connect with other entrepreneurs in our region that are running some phenomenal businesses. And I sat beside a guy that is a financial advisor here in town, and we were talking, and he asked me, how do you make money in your business? And I was like, man, that's a really valid question. I should probably talk more about this because I think it's really important to note that we structure our deals very different from what you would traditionally see if you went and placed money with a financial planner in, say, the stock market. And by the way, I'm not a financial planner, so please always consult your own and ask how they're doing their fees, how they're structuring it. The way that I've seen it true for my husband and I, we do have money invested with a couple different groups through 401ks and Roth IRAs. We've done some of that as well. And typically they're charging a percentage of the assets under management that you have. So maybe it's 1.25% of the full assets that are under management. So the performance does not dictate how much money they make. It's typically, again, how much they're managing. Whereas we do ours a little bit different. With passive investments in real estate syndications, typically we're putting our investors first. At least that's the deals that I look for, is really friendly towards the investor. They're getting paid first before we're making any money. So the way that we typically structure it is there's what's called a preferred return. That is preferential treatment to you as the investor. So you get the first, say 8, 9, 10%. Every deal's different. Every group is different, but you'll get the first, say 8% of distributable cash flow. And that would typically be annually. And then after you've received that return on your investment, then maybe there's a return of your investment. So if you put in, say, 100,000, we're going to give you back the first 8%, but it's not even giving you back. We're giving you a return of 8% of your investment annually. So $8,000 annually per year. And then after that, you're getting your capital back. And then we're having a split of, say, 70% of the profits to you as the investor and 30% to me as a GP. And I'm a part of a team, so it's not just me, but 30%, towards the GP team, or maybe it's an 80-20 split. So 80% to the investor, 20% to the GP team. And so we really don't make money till much further on in the investment, after we've hit your preferred return, after we've maybe returned your capital, and then we have that split on the back end. And so every deal is a little bit different, and you'll see an overall annualized return. You'll also see an internal rate of return, IRR. That's a video for another day. It's a little bit more complicated, but I just want to make it really clear that you as the investor, the way that I like to see deals, and again, it might be different with each group, but it's friendly towards you. You're the one that's making money first. You're getting all of your capital back first, and then you're seeing a split with the GPs much later on. And so we do not make money or much money until we perform, and we perform well. We're hitting our numbers. And so you might see like a 1 or 2% asset management fee for managing the asset throughout. So that is a fee that's probably going to be involved. And you also might see, say 2% acquisition fee on the front end. So that is something, that the team will split, because it does take some time, work, and money to acquire these assets, to go find them, the due diligence involved, travel, hotels, like all of the legal work that goes into it. There's a lot on the front end, but it's pretty minimal in terms of the amount that is being taken there on the front end. We really don't see much profit, much money being made until the back end. And so I hope that provides a little bit of clarity. If you have questions, though, please do reach out. I'd love to answer them for you.